They are not your favorite stocks. You certainly have no dreams of holding on to them for decades. These are not stocks that you hate having in your portfolio either. You are not looking forward to exiting the stocks with marginal profits. These are stocks that are constantly in the news but offer very little comfort. In short, stocks that have a history of long term underperformance are the focus of only meme creators. For investors, such stocks become the nagging doubt in their portfolios across market cycles. ITC became the quintessential example of a meme stock ever since the stock underperformed its peers in the post COVID rally. ITC was not new to such phases. In fact, over the past 2 decades, the stock has regularly spent years in hibernation, giving investors the jitters about holding it. So much so that over time, other underperforming stocks and sectors were referred to as the ITCs. Sometimes they were the technology stocks, sometimes auto, sometimes banking, and even food delivery businesses. From time to time, the stock has been weighed down by negative perceptions. Excessive government regulations on ITC's tobacco business, poor allocation of capital, low shareholder returns were all reasons why investors evaded the stock. Also, there was a long held belief that the company was underutilizing its cash reserves. This negative sentiment overshadowed the company's strengths in its FMCG and other growth businesses. However, a series of strategic moves and a renewed focus on growth have gradually turned the tables. In fact, ITC's recent outperformance has kept the stock in the limelight. What is most shocking is the fact that the periodical stagnation in the stock price did not stop it from beating the benchmark Sensex nearly 3 times over the past 2 decades. Also, its latest move to demerge the hotel business could also unlock value over the long term. Now, ITC is not the only stock that has had long periods of underperformance and has tested the patience of investors. In fact, investors are often in quandary about whether to hold on to the ITC-like stocks in their portfolio. So, here is a basic checklist to evaluate such stocks. First, evaluate intrinsic value versus market perception. For instance, ITC currently has over 120 hotels across 70 locations. However, the market perception about the conglomerate's hotel business segment is that it has been a cash drain. The high capex on the hotel business and the resultant subpar returns were reasons why the management sought an alternate structure. The hotel business contributed less than 5% of ITC's revenues and operating profits over the past decade. However, it accounted for more than 20% of the company's capex requirements. However, after the demerger, ITC Hotels will become the second largest listed hotel company by rooms. Here's a listing of the listed hotel stocks in India by the number of rooms. Post demerger, ITC will continue to hold a 40% stake in ITC Hotels. The balance will be held by the company's shareholders proportionate to their shareholding in ITC. Therefore, while the market perception may be that the demerger may not meaningfully unlock shareholder value, the intrinsic value of the hotel business seems to be potentially much higher. Second, don't ignore fundamentals. A company's worth is not understood predominantly by how its share price has moved, rather by its ability to generate and sustain free cash flow in the future, which in turn depends on profitability, reinvestment of profits, and longevity of the business. In fact, empirical evidence points to the fact that over the long run, stock prices are driven by the company's fundamentals. In the case of capex heavy stocks like ITC, it is important to keep a watch on the level of debt both at the standalone and consolidated levels. Remember, excessive leverage has brought in existential crisis for conglomerates like Z. Third, don't price in value unlocking upside. Many ITC-like large conglomerates and holding companies have massive value unlocking potential over the lifetime. The possibility of gains from the stocks once the subsidiaries become profitable and get listed keeps investors hooked. However, in the meanwhile, such stocks keep getting valued at a holding company discount. The biggest mistake most investors make in buying such stocks is paying a hefty premium to earnings for pricing in the value unlocking potential. Initially, ITC's decision to demerge the hotel business was received with stock market frenzy. However, eventually, market participants paid attention to the fact that tobacco and FMCG segments account for 80% of ITC's revenue. Hotels contributed just 5%. So, to expect that a capital intensive hotel business will immediately create shareholder value for ITC on demerger is unrealistic. Fourth, be patient about near-term earnings hiccups. Now, as a conglomerate, ITC has always attracted criticism for its capital allocation plans. Be it entry into hotels in the early days or paperboard and agarbatti later, the company's efforts to diversify from tobacco did not pay off for years. ITC had flagged its decision to explore alternate structures for its hotel business back in FY20 in the annual report. This was subsequently delayed by the pandemic. During the pandemic, the company's hospitality business, especially luxury hotel chains, suffered to a great extent. All this drew additional criticism from shareholders. The decision was to offload such asset-heavy businesses that are bleeding cash. Well, since then, the narrative has changed. ITC's hotel segment witnessed a remarkable recovery in financial year 2023 on the back of wedding season, leisure and business travel. The fourth quarter of financial year 2023 was very strong, where it almost doubled revenue and profits. Therefore, while the proposed demerger could ensure sustained value creation and synergies, investors need to be patient about near-term hiccups. And finally, the fifth point, be disciplined about the sell criteria. It is important to have a clear sell criteria for stocks which have had a history of unfavorable capital allocation. While valuations and business tailwinds may act in favor of the stock over long periods, poor governance can be a deal breaker. Therefore, to conclude, the ITC-like laggards in your portfolio could potentially offer you as much as 3 times the Sensex returns, especially when held over decades. However, ensure that you run through this checklist to evaluate whether at all you should hold on to the stocks. Hope you like this video. Thanks for watching.